Join me as I dive into the tricky world of cryptocurrency, taxes in Canada, and see if I can figure out what every investor absolutely needs to know. Cryptocurrency taxation in Canada is a critical topic that every investor needs to understand. As an investor, it's essential to stay compliant and avoid penalties. And with the ever changing landscape of cryptocurrency regulations, it can be overwhelming to navigate. Now, one common misconception among cryptocurrency investors is that they don't have to report their gains or losses because it's not a traditional investment. However, Canada Revenue Agency or CRA reviews cryptocurrency as a commodity, not currency. This is important because it means any profits or losses from buying, selling, or trading cryptocurrencies are subject to taxation. In simpler terms, if you bought Bitcoin or Ethereum, made some cash when you sold it, the CRA expects you to report that profit just like you would if you sold stocks. Another challenge many investors face is understanding how to report their cryptocurrency transactions. On their tax returns, the CRA requires accurate and detailed records of your transactions, including buying, selling, trades, or even cryptocurrency mining activities. Without the proper records, investors risk facing audits, fines, and even legal action. Now, here is when things get tricky. Cryptocurrency exchanges are obligated to provide you with tax forms, like traditional brokerage. This puts the responsibility squarely on the investor to track their own transactions. Imagine trying to track every trade, transaction, and purchase you made across multiple platforms. It can get complicated fast. To stay on top of this, it's a good idea to use cryptocurrency portfolio tracking tools. These programs automatically log your transactions, making it easier to track gains, losses, and fees accurately. Some even generate CR compliant tax reports, saving you massive headaches when tax season rolls around. When it comes to cryptocurrency taxation, capital gains are a significant area of concern. The CRA views cryptocurrency as a capital property, which means that the profits from selling or trading cryptocurrencies are subject to capital gains tax. Now, here's the catch: only half of your capital gain is taxable in Canada. So, if you bought Bitcoin for $10,000 and sold it for $20,000, you only need to pay on half of the $10,000 profit, which could be $5,000. But don't let that fool you. Those gains can still add up quickly, especially for investors who had made substantial profits during bullish crypto markets. And if you're actively trading multiple cryptocurrencies, these gains can multiply fast. In addition to capital gains, cryptocurrency investors must also comply with tax reporting requirements. The CRA requires investors report their cryptocurrency transactions on their tax returns, including the date of purchase and the date of sale, and resulting gain or loss. Now, cryptocurrency mining is another area that investors need to be aware of. The CRA views mining as a business activity, which means the miners are required to report their income and expenses on their tax returns. If you're mining cryptocurrency as a hobby, there are still tax implications. Any crypto you earn from mining is considered taxable income, and you're required to report the fair market value of those coins at the time you receive. Mining can be complex, especially for those who are also trading or holding cryptocurrencies. Keeping track of these different activities and how they impact your taxes is crucial. One crucial insight that can save investors from costly mistakes is the importance of keeping accurate records of transactions. This includes maintaining a detailed ledger of all buys, sells, trades, and mining activities. Without accurate records, investors risk facing audits, fines, and even legal action. Imagine the CRA knocking on your door 3 years later asking you for details about a Bitcoin sale from 2021. If you don't have those records, you could face some serious penalties. Accurate recording keeping is especially important because CRA can audit cryptocurrency investors years after the initial transaction. By keeping detailed records, investors can ensure that they're compliant with tax laws and avoid costly mistakes. In addition to record keeping, investors should also be aware of implications of cryptocurrency airdrops and forks. An airdrop occurs when a cryptocurrency project sends free tokens to the investors' wallets, often as part of a marketing campaign. Many people don't realize that these free tokens are considered taxable income. So if you receive $200 worth of crypto from an airdrop, that's reportable income. Similar cryptocurrency forks, blockchain splits creates a new coin can create unexpected tax obligations, even if you didn't ask for those new coins. The CRA may still consider them taxable. Another overlooked area is cryptocurrency gifts. Some investors believe gifting crypto avoids tax obligations, but the CRA still expects you to report these transactions, even if no cash was exchanged. Lastly, charitable donations made in cryptocurrency are subject to their own set of tax rules. Donating crypto can provide a tax break, but only if handled correctly with detailed. In summary, understanding the tax obligation is critical for cryptocurrency investors in Canada. By being aware of the capital gains, tax reporting requirements, and the implications of trading, mining, airdrops, and even gifts, investors can avoid costly mistakes and ensure compliance with the tax laws. Navigating the world of cryptocurrency taxes may seem overwhelming, but staying informed and organized is key. Use tracking tools, maintain clear records, and when in doubt, consult a tax professional who understands cryptocurrency. Thanks for tuning in. If you've got any experience with cryptocurrency taxation in Canada, be sure to share them in the comments below. And if you're new here, consider subscribing for more content on cryptocurrency strategies and tips. Thanks for watching.